In the careful evaluation of any enterprise, whether a commercial enterprise or a political operation, there comes a definitive moment when the internal financial realities can no longer be reconciled with the public declarations of prosperity. It is a moment that signals something far more significant than a simple cash flow shortfall. It reveals a fundamental insolvency, a condition where the basic mechanics of daily operation can no longer be funded through available capital, where obligations to creditors are not being honored, and where the chasm between the story being told and the numbers on the ledger has become unbridgeable. This is precisely the juncture we find ourselves at this evening, following an urgent development in which internal accounting documents from Donald Trump's 2026 presidential campaign have been made public by investigative reporters. These records reveal that the campaign has reached a state of effective insolvency, finding itself incapable of meeting its payroll or satisfying its vendors, and is now subsisting solely on emergency financial injections that may themselves contravene the regulations governing campaign finance. Before we delve deeper into the implications of this situation, if you find this manner of immediate financial scrutiny valuable, I would ask you to please take a moment to like this video and subscribe to this channel. Your support is what enables us to continue delivering this caliber of real-time analysis, examining breaking developments with the kind of business acumen required to grasp their full consequence. From the viewpoint of an investor or an analyst, this is not simply another difficult headline in a series of challenges for this political operation. This is about comprehending the precise mechanisms through which a campaign organization, once flush with substantial resources, arrives at a point of financial collapse. It demands we investigate what these confidential papers illuminate about the specific fiscal choices and conditions that precipitated this crisis. We must consider how a campaign's bankruptcy influences not merely its electoral chances, but also the wider legal and commercial endeavors that rely on a functioning political apparatus. And we must understand what occurs when the divergence between projected resources and the actual cash position grows so severe that normal functions cease and creditors initiate legal proceedings to collect what they are owed, potentially unearthing further financial irregularities in the process. A financial disintegration of this magnitude does not typically announce itself through managed, gradual disclosures designed to preserve dignity and options. It erupts suddenly, when entities that have been projecting operational strength while privately grappling with shortfalls reach the absolute limit, the point where employee compensation cannot be processed, where suppliers will no longer extend credit, and where the narrative of viability can no longer be sustained. And that is the very subject I wish to explore with you today. For this particular financial collapse carries with it ramifications that reach far beyond the immediate campaign organization, speaking to more profound inquiries about the candidate's overall fiscal health, about the unsustainable rate at which legal expenditures have devoured available capital, and about what transpires when even those supporters who might provide a financial lifeline conclude that the enterprise has become a vessel into which additional money will disappear, with no reasonable expectation of recovery or return. In my long experience observing the flow of capital, I have borne witness to the manner in which organizations consume their resources when their outlays consistently surpass their income, and when leadership declines to acknowledge this unsustainable trajectory until a crisis forces that recognition upon them. I have noted how sophisticated analysts learn to distinguish between entities confronting temporary hurdles that can be surmounted with prudent adjustments, and entities facing a structural insolvency that cannot be resolved without a fundamental restructuring or a terminal liquidation. I have observed how financial pressure within one segment of an interconnected business and political network inevitably cascades to impact other operations, as shared resources are diverted to confront the most urgent, immediate demands, while the longer-term prospects for sustainability are sacrificed. In the world of finance and governance, when a legislative body enacts a massive, complex tax bill in the dead of night without proper deliberation, it indicates something far more troubling than mere procedural haste. We find ourselves at precisely such a crossroads with the so-called Retirement Security Enhancement Act, which was pushed through the Senate just yesterday. To an investor's eye, this has little to do with reforming the tax code. and everything to do with the most significant seizure of retirement wealth this nation has ever witnessed, all masquerading as a benevolent gesture for older Americans. You must understand, foundational shifts in how retirement savings are taxed do not occur because elected officials have developed a newfound concern for your well-being in your later years. They occur when the Treasury is running dry and the government has identified a massive, untapped pool of capital it can lay claim to. And that is the central issue I wish to discuss with you today, because embedded deep within this statute are clauses that will systematically dismantle the value of every 401k, IRA, and pension plan in the United States. Before we examine the specific threats this law poses to your life savings, if you are interested in safeguarding your financial future from this kind of governmental overreach, please take a moment to like this video and subscribe to this channel. Comprehending these changes today could preserve hundreds of thousands of dollars for you in the future. In my many decades of building capital and analyzing fiscal policy, I have witnessed the government extract revenue through numerous inventive methods, but I have never before observed them design such a thorough and systematic attack on the very concept of retirement savings, all while labeling it an improvement. As an individual who has devoted a lifetime to understanding tax code and assisting people in protecting their assets, I can state with certainty that what Congress has just accomplished makes the initial imposition of the income tax appear straightforward by comparison. You see, when politicians title a piece of legislation the exact opposite of its true function, they aren't suffering from confusion. They are relying on you to be confused. The Retirement Security Enhancement Act does not enhance your security. It only enhances the government's income stream. Let me be perfectly unambiguous about the events of yesterday. This is not a slight modification to annual contribution caps or a minor adjustment to withdrawal rules. Congress has just fundamentally altered the foundational agreement between American workers and their retirement funds. The core promises made when 401k plans were established decades ago, that your capital would compound without tax interference until you retired, have just been shattered. What was ratified yesterday converts retirement accounts from vehicles for tax-deferred growth into reservoirs of government revenue, to be accessed whenever congressional spending demands it. The first toxic element concealed in this legislation is a clause titled the Mandatory Distribution Acceleration Provision. Effective the 1st of January, any individual with more than $200,000 across all their retirement accounts will be compelled to begin taking required minimum distributions at age 60, not the previous age of 72. This represents 12 additional years of forced withdrawals, 12 additional years of taxation, 12 additional years of depleting accounts that were intended to provide security throughout one's retirement. From a financial strategy standpoint, this isn't merely shifting the goalposts, it is moving them as you are in the middle of your kick. In corporate terminology, it is the equivalent of your employer promising your pension vests at age 50, then changing the rule to 62 after you have already celebrated your 61st birthday. Yet the acceleration provision seems almost lenient when compared to what they have termed the wealth equity adjustment. Any retirement account exceeding $1 million will now be subject to an annual wealth tax of 3% on the amount above that threshold, irrespective of whether you take any distributions. If you have responsibly saved $1.5 million for your retirement, you will owe $15,000 every single year, for no other reason than having saved successfully. This is not a levy on income or on investment gains. It is a tax on existence. The money you were already taxed on when you earned it, that you saved in accordance with the regulations, that you invested prudently, that very capital is now being taxed a second time, simply for residing in your account. The mathematics underlying this wealth tax are utterly destructive when you consider the power of compound interest. A 3% annual tax on assets may sound modest, but over a 20-year period, it confiscates nearly half of your account's value. And that is before you include the regular income taxes due upon withdrawal. Combine them, and the government ultimately claims over 70% of what you diligently set aside. In investment terms, they are not partners in your prosperity. They are predators on your preparation. The ant stored food for the winter while the grasshopper idled away its time. Now the grasshopper gets to vote on seizing the ant's provisions. Tucked away on page 783 is something even more pernicious: the effective elimination of the inherited IRA. Under current law, a surviving spouse can inherit an IRA and maintain its tax-deferred status. Children can stretch the distributions over their own life expectancies. That entire system is terminated as of December 31st. All inherited retirement accounts must now be fully distributed and fully taxed within a mere 12 months. If a parent bequeaths to you a $500,000 IRA, you have one single year to pay income tax on the entire sum. For most beneficiaries, this will catapult them into the highest possible tax brackets, transforming an inheritance into an exercise in income confiscation. The stated justification for this provision reveals the government's true motive. They assert it encourages fairness by preventing the transfer of dynastic wealth. Yet the average IRA holds approximately $200,000. These are not dynasties. They are middle-class families attempting to pass a modest legacy to their children. The authentic dynastic wealth resides in complex trusts and foundations that this legislation carefully avoids. Once again, Congress has taken aim at the responsible savers while shielding the genuinely wealthy who possess the means for sophisticated tax avoidance. But the situation deteriorates further. The bill incorporates a retroactive Roth recapture provision. For a quarter century, Americans have been executing conversions from traditional IRAs to Roth IRAs, paying the tax liability immediately in exchange for the guarantee of tax-free growth in perpetuity. Congress has just shattered that guarantee. Any Roth conversion completed within the last decade can now be subject to recapture taxes if the account value grows beyond certain, arbitrarily set limits. You followed the rules, paid the taxes up front, executed the conversion, and now they are altering the terms after the fact. The mechanism of this recapture is intentionally convoluted. If your Roth IRA grows at an average annual rate exceeding 7% over any rolling 5-year period, the growth above that threshold becomes taxable. This means that if you invested wisely and your portfolio performed well, you are penalized. If the financial markets experience a few strong years, you will owe taxes on money that was supposed to be forever free from taxation. In business terms, this is like signing a fixed-price contract only to have the supplier return later to demand more money because you became too successful using their product. The administrative burden this creates will obliterate smaller accounts. Every single retirement account must now file quarterly statements with the IRS, declaring current valuations, growth rates, and distribution schedules. Failure to file results in a penalty of 5% of the total account value per quarter. Miss one filing, and 20% of your retirement savings instantly disappears. The compliance costs will consume thousands of dollars annually for anyone with more than one account. They are not merely taxing your money. They are taxing your time and your patience until you surrender and simply pay whatever they demand. Page 912 contains what may be the most cruel provision of all, the Social Security offset adjustment. If your annual distributions from retirement accounts exceed $50,000, your Social Security benefits will now be reduced on a dollar-for-dollar basis. Save too diligently for your retirement, and you forfeit the Social Security benefits you paid into for 40 or 50 years. This is not means testing, it is a punishment for thrift. The government compels you to pay into the Social Security system, then confiscates those very benefits if you were disciplined enough to save independently. The timing of this law is not coincidental. The baby boomer generation is retiring at a rate of 10,000 individuals per day, transitioning from being net contributors to the system to being net recipients. The government needs to capture their wealth before they have a chance to spend it. By accelerating required distributions, imposing taxes on assets, and eliminating inheritance strategies, Congress has engineered the most substantial intergenerational wealth transfer in history, moving capital from retirees directly into government coffers. This is not tax policy, it is generational theft disguised in legislative language. International clauses buried in the bill expose its overarching ambition. Americans residing abroad will now face double taxation on their retirement accounts. Foreign tax credits will no longer be applicable to retirement distributions. If you choose to retire to Spain or Italy, you will pay taxes to both your host nation and the United States, with no relief. The message is unambiguous. Your retirement savings belong to the U.S. government, regardless of where you choose to reside. They hold a claim on your future, no matter where you attempt to enjoy it. The provisions affecting small businesses are equally devastating. Companies can no longer take a tax deduction for matching contributions to employee 401k plans above 3% of an employee's salary. This will eviscerate employer-sponsored retirement benefits. Why would any corporation offer matching above 3% if it receives no tax benefit for doing so? The answer is, they will not. Millions of workers have just unknowingly lost a significant portion of their employer contributions. The government hasn't merely taxed your savings, it has prevented you from accumulating them in the first place. Self-employed individuals face particular targeting. Contribution limits for SEP IRAs and individual 401ks have been slashed by 60%. If you are a consultant, a freelancer, or a small business owner, your capacity to save for retirement has been decimated. The message from Congress is clear. Work for a large corporation or abandon hope of a secure retirement. Independent workers have been relegated to second-class citizenship within the very retirement system they often contribute the most to. The impact on state and municipal pension funds is catastrophic. These public funds rely on their tax-exempt status to achieve the compound returns necessary to meet their obligations. This new law eliminates that exemption for any pension fund holding over $10 billion in assets. The pension systems of every major city and state have suddenly become taxable entities. The pension crises in states like Illinois and California have just been transformed into pension catastrophes. Teachers, firefighters, and police officers will all see their future benefits cut as these funds struggle to pay new federal taxes. Here is something particularly deceitful. The legislation includes automatic adjustment triggers that are tied directly to the federal deficit level. Should the deficit exceed certain predefined thresholds, the taxes on retirement accounts automatically increase. Congress has effectively made your retirement savings the automatic backstop for their fiscal irresponsibility. They can spend with abandon, knowing that retirement accounts will be systematically drained to cover their deficits. Your 401k has become their emergency fund. The changes to health savings accounts are receiving less attention but are just as destructive. HSAs will lose their prized triple tax advantage starting next year. Contributions will remain deductible, but investment growth and withdrawals for qualified medical expenses will become taxable. The one savings vehicle that effectively helped people prepare for healthcare costs in retirement has been rendered virtually useless. Since medical expenses represent the single largest cost for most retirees, Congress has just eliminated the only tax-efficient method of saving for them. Precious metals held in retirement accounts face specific targeting. Gold and silver bullion held in such accounts will now incur an annual assessment fee of 5% of their total value. If you sought to protect your retirement from currency devaluation by holding physical assets, you are now being penalized. Paper assets can be inflated into worthlessness, but physical assets represent a form of wealth that challenges government control. This provision betrays their underlying fear. They require your wealth to remain in paper form, where it can be confiscated through both inflation and taxation. The regulations for cryptocurrency are even more draconian. Any digital assets held within retirement accounts will be marked to market daily, with taxes due quarterly on all unrealized gains. If the value of Bitcoin rises 20% in a quarter, you will owe taxes on that paper profit, even if you never sell a single coin. However, if its value plummets 30% the following quarter, you cannot claim the loss. It is a system where the government wins on the upside and you lose on the downside. They are not seeking to regulate cryptocurrency. They are making it impossible to hold within the sanctioned retirement system. Educational savings accounts have been swept into this vast wealth grab. Funds held in 529 college savings plans will now count toward the $1 million threshold for the retirement account wealth tax. Save for your children's education, and you will be punished with additional taxes on your retirement savings. Coverdell education savings accounts are being phased out entirely. The message is unequivocal. Do not save for education. Do not save for retirement. Instead, become dependent on government programs that they control and can modify at their whim. The enforcement mechanisms established by this bill are staggeringly intrusive. Financial institutions are now required to report all account balances to a new federal database on a monthly basis. Every transaction exceeding $600 will be automatically flagged. Every transfer between accounts will require pre-approval. This is not merely tax collection. It is a system of comprehensive financial surveillance. Your retirement account has become a transparent window into your entire economic life, continuously monitored by bureaucrats who will determine if you are saving too much. Artificial intelligence systems will be deployed to monitor all accounts for optimization strategies. If you legally minimize your tax burden through prudent planning, you will be flagged for enhanced scrutiny. Adhering to the law but paying less tax is now categorized as suspicious activity. The bill explicitly uses the phrase aggressive retirement planning as justification for audits. Preparing for your own future is now considered an aggressive act against the government's financial interests. The penalty structure reveals the true confiscatory intent. Fail to take a required distribution? Face a 50% penalty. Make an excess contribution? Face a 100% penalty. File paperwork late? Face a 20% penalty. These are not penalties designed to encourage compliance. They are mechanisms for wealth confiscation. The sheer complexity of the new system ensures that nearly everyone will eventually make a mistake, and the severe penalties ensure that those mistakes result in a permanent transfer of wealth to the government. It is a system engineered for failure so that they can collect on that failure. State governments are already reacting to these federal changes with their own wealth grabs. California has announced a state-level retirement tax that will be applied on top of the new federal taxes. New York is contemplating an exit tax on retirement accounts for residents who move to other states. It is no longer just the federal government. State administrations see the precedent being set and are demanding their share. Your retirement account is becoming a piggy bank for every level of government, each taking a turn with the hammer. The economic modeling used to justify this legislation is pure fantasy. They project $10 trillion in new revenue over the coming decade, but that assumes people will not change their behavior, financial markets will not react, and retirees will not flee the country. When you tax something, you inevitably get less of it. Tax retirement savings, and people will cease to save for retirement. What is the consequence? Dependency on government swells, unfunded liabilities explode, and the entire system collapses. They are not solving a fiscal crisis. They are dramatically accelerating its arrival. America's international competitiveness has been mortally wounded by this bill. Nations like Singapore impose zero taxes on retirement savings. Dubai offers golden visas to affluent retirees with no wealth taxes. Portugal had created specific programs to attract American retirees. The wealthy, the skilled, and the educated will depart. The resulting brain drain and capital flight will intensify. America is becoming a nation that is hostile to success, allergic to savings, and antagonistic toward anyone who plans ahead. That is not a formula for continued economic leadership. It is a roadmap for national decline. The bond market is already pricing in these seismic changes. Treasury yields are falling as investors realize that millions of retirement accounts will be forced to liquidate holdings to pay these new taxes. When a massive involuntary sell-off of bonds occurs to cover wealth tax liabilities, it will suppress yields, further punishing savers while rewarding the primary borrower, the government itself. They have engineered a scenario where they tax your savings while simultaneously paying you nothing for the privilege of holding their debt. Corporate America is quietly adapting to this new reality. Major employers are beginning to terminate their 401k programs entirely, replacing them with simple, taxable bonuses. Why offer retirement benefits that employees can no longer effectively utilize? The demise of employer-sponsored retirement plans will push millions more toward government dependency. This is not an unintended flaw in the legislation, it is a calculated feature. A population that is dependent does not revolt against the entity that provides for it. The insurance industry perceives a significant opportunity within this chaos. Annuities, life insurance policies, and other insurance-based products have been largely exempted from the bill's most punitive provisions. Expect a massive marketing push toward these often expensive and inefficient products as the last remaining tax-advantaged savings vehicles. The insurance lobby invested heavily to ensure their products were spared. Your retirement savings are being systematically funneled from low-cost index funds into high-fee insurance products that enrich salespeople and corporations while impoverishing the very retirees they claim to serve.